Hi, Steve Walker at Promise Money. Today I'm going to talk about what are the different types of bridging, because bridging is a term that's used to, I guess, describe a methodology of borrowing, but there's lots of different uses and lots of ways of spinning bridging. Let's start off by talking about some of the restrictions of bridging, because there are two key types of bridging which are regulated and non-regulated. And just to explain that, a regulated bridging loan is one which is generally, I'd say 99% of the time, secured on your home and is for personal purposes. Because it's secured on your home, it is regulated by the Financial Conduct Authority, and a whole set of different rules apply. The key rules are maximum loan 12 months, you can't take it for longer, advice by an authorised mortgage broker, or certainly the support of an authorised mortgage broker. And because it is regulated, the FCA will require the broker, the lender, to tick far more boxes for compliance, and therefore it can take a little bit longer. It is a more onerous process. That's your regulated. Non-regulated, this is for property investors generally, or business people. If you want short-term bridging finance to support something you're doing for business, secured on business property, buy-to-let, commercial property, or even a second charge on your home, if it's for business purposes, can be non-regulated. And there are far more lenders. Non-regulated lenders, thousands. Regulated, tens. Not many tens either. So your choice is massive on your non-regulated, not so great on regulated. Advantage of regulated is these lenders are very closely vetted by the FCA. They are going to want to treat you right. They're going to want to be seen to be treating you right. And therefore you're in pretty safe hands. And if you're going to a regulated mortgage broker who deals with regulated lenders, that broker's going to want to treat you right as well, because they have to, otherwise the FCA is going to come onto them like a ton of bricks. Once you step into the non-regulated territory, those lenders very often don't have the same restrictions by the FCA. So you can be getting a little bit into the Wild West if you don't know what you're doing. So if you are going for non-regulated bridging, I'd say always go via a regulated broker, because then you've got a regulated broker to go back to if you do hit a problem. Even if the lender isn't regulated, the broker is. So that's regulated, non-regulated. Another factor, irrespective of the type of bridging loan you go for, is whether or not you're going to go for retained or rolled up interest or service interest. And very simply, service interest is like a mortgage. So you have the bridging loan, the interest is charged every month, and you pay it every month, and you evidence at the start that you can afford to pay it. That's service interest. But what most people use bridging for is for rolled or retained interest. Now, go to our YouTube channel, there's a video on rolled and retained interest. There's also a video on regulated and non-regulated, if I haven't explained it well enough for you in that short sentence. So retained and rolled, the calculation works slightly differently, but in essence, you are borrowing the interest. So if you imagine a £100,000 bridging loan, and we'll ignore fees from it for now, £100,000 net bridging loan on a service basis, you're paying the interest every month and the loan stays at £100,000. On a rolled or retained interest, £100,000 loan, the lender's going to say, right, okay, you want this over 12 months, therefore we are going to charge you 12 months interest and we'll lend you that. So instead of borrowing £100,000, you're borrowing £100,000 plus interest, which could be, I don't know, it could be £112,000. And at the end, you pay back £112,000. The advantage is you've not had to pay £1,000 a month during that 12 months. That's the gist of it. So you're borrowing the interest. The downside is you're paying interest on interest, which doesn't make a significant difference to the cost. But the other downside is if you're tight on equity and you're trying to borrow the maximum amount against the property value, because the interest is added to the loan, that means your loan of £112,000 nets you 100. So if you're trying to get the maximum amount, you can't get the £112,000 because you've got to take the interest off. You only get 100. If it was serviced, you might be able to get the £112,000 in your hand at day one, because you're servicing the interest because it hasn't been deducted. Don't know if that's clear, but if not, go and watch the video on retained and rolled and some examples in there. And go on the website, there's some worked examples as well on the Promise Money website. So those are sort of features of all bridging loans which tend to exist. So now let's get into specific types of bridging. Well, the simplest bridging is going to be your standard residential property. You're using a bridging loan to buy residential property quickly. It could be because you want to live in it and you haven't sold your own home, in which cases that's going to be a regulated resi bridge. Or you might want to buy it at auction and you need it quickly. So, and that could be a property you're buying that you eventually intend to sell. That could be a non-regulated bridge. And they're straightforward because the property is straightforward. Lenders find them easy to sell, easy to assess. It's just straightforward and it's bog standard bridging. So let's complicate it a little bit. You might say, okay, well, it isn't a residential property, it's a commercial property. It's the same process, but the legal side of commercial is a little bit more in depth because of the planning, because of the use class, because of how it might be used. But most importantly is that a lender can't sell a commercial property as easily and as quickly as they can sell a residential property because the market isn't as strong for them. And the process for buying a commercial property takes longer. And because of that, they simply reflect that additional risk to them by charging you a higher interest rate and potentially lending a lower loan to value. So your standard resi bridging loan could be up to 75% loan to value and rates for lower loan to values down as low as 0.55%. If it's commercial, you could be looking at 0.85 to 1% quite easily because the lender isn't so keen, and the chance of getting 75% loan to value are pretty slim. You're probably 65 to 70% with most lenders who are in that sector. Okay, so that's your difference between standard resi and standard commercial. Then it gets more interesting because you might think, right, well, we want to do a refurbishment on this property and I want to do this refurbishment during the term of the loan. So the lender's thinking, well, okay, that's fine. So we need to understand, because we need to know what your exit's going to be and we need to make sure you can get to your exit. Therefore, we need to understand what's the work that you are doing and what's the cost of those works and what will it be worth when it's completed. Because if we don't understand that and don't agree with it, there's a possibility that we could lend the money to you, and because you've got your numbers wrong, you can't get to your exit and we're stuck with a property we can't sell because you've knocked it about. That's your light refurbishment bridge. And there are some specific products for that. And actually you can get a higher loan to value on products like that because providing you've done your homework and they agree with your numbers, your cost of conversion and what the works you're going to do, and they agree with your GDV, they'll say, actually, we can see the work you're going to do, therefore we will lend you a little bit more at day one to help you do that. Provided you can evidence you've got the cash to finish off the rest of it, so we can see that all the numbers work out, we're happy to do it. So that's your light refurbishment. I think I also define light refurbishment as not requiring planning and not requiring significant building regs. You know, it's easy work. It's kitchen, bathroom, decoration, that sort of thing. Next, you get into heavy refurbishment, and that's where you might be extending a property. You need planning consent to do some of the works that you want to do. You're making structural alterations, and it works the same as refurbishment. The lender's just still going to want to know, what are your costs? How long is it going to take you? What's your exit? What are the works you're going to do? And what will it be worth when it's finished? And in this case, as in with the light refurbishment, they're going to say to the valuer, go out and value the property and tell us that these numbers are correct, so that they know that they can rely on them. Because if they're wrong and your gross development value, your finished value is lower than they were expecting, then that could give them a problem on you selling and getting out and paying them back. If your costs are higher than you think, and the valuer says your costs are higher, that could give them a problem because you could run out of money halfway through and all of a sudden you hit a problem. Where's that money going to come from? So the lender wants to see from beginning to end that the numbers stack up and it's viable. And as you get into heavy refurbishment and beyond that, what the lender's also factoring in is what's it going to cost us to put this right if you can't? Let's say you buy a property and and you're a builder yourself and you do the work yourself and it all goes horribly wrong, or they have to foreclose. The lender's thinking not what is it going to cost you to do that work, what's it going to cost them as a lender to do that work, because they need to get that done in order to get the property finished, in order to sell it. Because they don't want to sell it as a part completed development, because the only people who are going to buy that are other developers, and they're going to want to nick it, and the lender's going to lose money. So they're thinking, how do we get this finished? Which is why they're going to scrutinise your numbers so much. So that's heavy refurbishment. That drifts very neatly into property conversion. It could be commercial converting to residential, or semi-commercial, shop downstairs, flat above, converting upstairs into residential. And again, there are specific products for that as well, and specific lenders who like that sort of area. And the lender that's going to do that may not be the lender who's going to do the light refurbishment, and certainly may not be the lender who's going to do a standard residential. It's a totally different market with different disciplines, different expertise, and different funding sources behind them. So that's your property conversion. There are specific products for that as well. And there are some videos on our YouTube channel. There's one 85% loan to value refurbishment. There's another one which is property conversion, and there's a few actually on development finance, explaining what development finance is and some of the products available to you. And that's the next thing, is development finance, which is a step beyond property conversion, because it's potentially going to be ground up development finance. So you've got a plot and you're looking to build a house on it, and the lender's going to be, again, supremely interested in your numbers. Do they stack up? Will it cost what you say? Will it be worth what you say? What are the contingencies? Have you factored in anything you've got to pay the council levies? All those sort of things are all going to get factored into it. And the more complex the application comes with refurbishment work, the higher your costs are likely to be in terms of valuations, because the valuations are more complex, and the more scrutiny you're going to come under from an underwriting, because there's more going on. It's as simple as that. So that's your development finance, and really that's just you're just looking at simple bridging through a stage of complications which are, I guess, dictated by the amounts of work that you're looking to do. Then you've got business bridging. Somewhat different. It's not a straightforward residential bridging application, although it could be secured on a straightforward residential property. But the purpose is for business purposes. So it might be that the exit is not sale of the property, or is not remortgage of the property. Business bridging is not as common as as property development bridging, I have to say, but you'll still need a very strong exit for it. So you're going to have to demonstrate to the lender that you've got a really strong exit. If you say to a lender, and I've seen them like this, I've got an opportunity to buy all of this equipment for £100,000. I need a bridging finance to buy this equipment for £100,000, and I'm going to make a load of profit when I sell it. In fact, I'm going to sell it for £175,000. That's not an exit, that's a wish, that's a hope. Lenders are looking for strong exits which they can numerically quantify, rather than what you would like to happen. So be aware of that if it's business bridging. And then finally, something we're seeing more of these days, which I would call hybrid bridging. And this is used in scenarios where people maybe want to buy a business, but the numbers don't quite stack up, and they can't get the affordability to work, because for a regular commercial loan. So it's a cross between a commercial loan and a bridge. And what lenders will sometimes do is say, well, look, we will lend you X amount, but we're going to give you a year with no payments. And we're going to roll up those repayments into the loan, like on a rolled or retained bridge. So you'll get 9 months where there's no payments to make because we've built the interest into it, and then or 12 months, or whatever that term might be. And then after that, we expect you to service the loan. And that's a hybrid bridge, which is really useful for startup businesses, or less developed businesses, or businesses where you're trying to turn it around, that sort of thing. So that's hybrid bridging. What do they have in common? Apart from your standard residentials, where you might be able to get away with a valuation, you're going to need a valuation on all of these, a full survey. The legal process is going to be similar, but the more complex it is, the more legal work will be required, more things to look at. The more complex the property is, the more things there are to look at. But the process is essentially the same for all of them. But you can use bridging in lots of different ways. What I would suggest is work out what's important to you, what you're trying to achieve. Work out what the cost is of the things that you're trying to achieve, especially if you're doing refurbishment and those sorts of things. What are those costs going to be? And then you need to talk to somebody who can find you a lender that can fit into that area and give you some indicative costs, because you need to know what the interest is going to cost you, you need to know what the fees are going to be, and then you need to work back from that to see if it all works out, because there's no point taking out bridging, which is more expensive than a term loan, than most term loans, taking out bridging to achieve something if you find that all your profit has been eroded because your eventual value was lower than you thought, your costs were higher than you thought, and the bridging costs and the interest charges were more than you thought. I would just add by summarising that one thing that you also need to consider is the term of the loan. These with bridging loans, they do have an end date by which time the lender expects you to exit, as you have said, normally sale or refinance. Be realistic about that as well. Don't think that because you're buying a property at auction and it's going to take you 4 months to refurbish it, that you're going to be out of your bridging month in your bridging loan in 6 months, and therefore take out a 6 month bridging loan. The lender probably wouldn't even grant you a 6 month bridging loan because they know it takes longer. Because to get the sale, things go wrong in the conversion or in the works, and in the sale things go wrong. And the reason I say it's important that you get that bit right is because if you go for a 6 month bridge and you get to the end and you've not exited, the lender, they're not going to rush to repossession, or they almost shouldn't do, because that's not in their interest either. But what they will do is say, oh, we need to renew the facility, so we're going to charge you another fee. And they might even charge you a higher rate of interest because you've now gone into a penalty phase. So you want to avoid that at all costs. Anyway, do go to our website. If bridging is something you're looking at, click on bridging on the Promise Money website. There's a section there, top questions. There's over 100 questions there on bridging finance that people have asked us with the answers written. And there's videos on the pages as well, but there's also lots of videos on the Promise Money YouTube channel, so go and check that out as well. Please don't forget to like our videos, subscribe and share them, and yeah, we'll catch up with you soon, and if we can be of any assistance, do get in touch. Thanks a lot. Bye bye.